Now, our trade targets will usually be Fibonacci projections or extensions, depending on the particular trade entry setup and the reasons for the trade. Okay, we'll use the equal legs target of the cycle we're trading the majority of the time. Now, if equal legs falls near a figure, we can target that figure. That's if the figure maybe is a little bit above. Now, if the figure falls below, or we have a major support and resistance level below that level, or, depending on which direction you're trading, obviously, if it comes first, I should say, okay, it comes before our equal legs targets, we can target those levels. However, we must make sure we have a good reward to risk ratio. Okay, and that should come before ever entering the trade during the reward to risk analysis. So when you're performing your initial analysis before you enter the trade, when you're assessing the trade, it gets back to our trade assessment. Okay, we want to look for major levels of support and resistance that could interfere with our trade targets. So we want to make sure we still have a good reward to risk ratio. Right? Now, for the MACD divergence setup that we trade, we will use Fibonacci extensions 127.2 and the 161.8. And we'll cover this specific setup in another section shortly. And this is what we call the simple objective divergence trading strategy. And it's a strategy I'm sure many folks here at Forex Mentor are already familiar with. We've been trading it for quite some time. Now, we also have a specific target for counter trend corrective divergence swings that we will cover in another section here shortly. And this can also be applied to when we're entering using our top-down trading. We have a very specific target for those types of corrective divergence steps where we're not looking for reversals, we're just looking for a correction of that cycle. So I mean, it's not a secret. Basically, we target the higher the low between the points that diverged. Okay, and that's a very common target for a corrective divergence move. And we'll cover that again. We'll cover that in detail here a little bit later. Okay, but one thing to remember, it is important to always set a trade target and hold for it unless there's a technical reason to disqualify the pattern or a particularly high-risk event upcoming. For example, NFP or an interest rate statement, something like that. We're not talking about just your intraday micro or macro releases. We're talking about interest rate statements, central bank member speeches, press conferences, those kinds of things. Monetary policy statements, anything that could really have a really significant impact on the volatility of the market. Okay, otherwise, you want to hold for your targets unless the setup is disqualified. Let's say the pattern gets disqualified after it moves. Maybe it starts to move a bit sideways or there's a lot of different ways that a setup can be disqualified. Once the pattern starts to play out more, or the other thing is if you see a qualified divergence in the other direction. A qualified divergence in the other direction is a good signal to go ahead and cut that trade short, take some profits, or wherever you're at in that part of the trade, you probably want to go ahead and get out of it. Okay, so let's go ahead and take a look at how we're going to set our trade targets. All right, so this is the EuroCAD, and here's an example of, here's a divergence setup right here. Okay, now you see we had a divergence on this degree right here with price moving higher, MACD cycling lower. We came through and qualified this right here when we took out this particular low. Now, if you're using one of the more aggressive strategies, that we have as far as a trend line break strategy here, okay, or if you're using the candle pattern strategy, those would have given you a better opportunity to get into this particular trade because we didn't have much of a pullback here. But what I want to show is the targets we'll set on these types of trades we'll use our Fibonacci projection or expansion tool, okay, and we would measure from this low to this high, and we would target that equal legs 127 area. Let me move this 162 out of here so it doesn't confuse us. here's equal legs, right here. Okay, so the equal legs would be the target. Now, the most important thing you need to assess here is your entry with your stop loss. So you would want to make sure, if you're going to take a short position, depending on how you're opening it, especially if you're opening it down here, remember, your stop loss needs to be above the high. Okay, so your stop loss needs to be above this point here. And if your target is right there, let's see what does that give us? Nope. Let me move this one more so I can get these lines out of the way. Okay, there we go. That didn't give us a very good reward to risk ratio. Okay, so this particular setup wouldn't have given us a very good reward to risk ratio. Now, if this would have pulled back, to 50 to 62%, that would have made a big difference. Okay, that would have made a really big difference there. And you can see then the reward to risk would have been just over 2.5 to 1, over 2.5 to 1, so actually 2.76 to 1. Right, so obviously this did not pull back for that entry, but a lot of these will. A lot of times you'll see these pull back 50 to 62%, and that'll give you a much better reward to risk ratio with that kind of a target. Okay, but the equal legs target. Now, this is another thing that we'll use if we are using the smaller degree time frames to enter into larger degree patterns. Okay, so for example, I just back this chart. This is still the EuroCAD. For example, you see this very large divergence in here. Very large divergence. We have a significant decline on the 4-hour chart. We're seeing a corrective setback here. Okay, now, if we zoom into this, you see this divergence from the smaller degree time frame. You can see that divergence here as well. Then we had a strong, solid break extension move and then a pullback. All right, our target on this particular setup, remember, we're looking at this as our initial leg to the downside, and we're looking for an equal legs move of that cycle. Okay, so our target is all the way down here at 147. And I say 147 because 147.12 is equal legs. In this case, if it's 147.12, we're going to target that 147 figure. You better believe it. Okay, but in this circumstance, we're trading this smaller divergence for the larger pattern, but we're using this as our entry. Look at this sharp decline after this divergence right here. Price moving higher, MACD cycling lower, strong decline, and look at the pullback. Now, let's look at the reward to risk we would have on this type of a trade. Again, a short position. Actually, I'm sorry. Let me draw the fibs first. All right, so here's our Fibonacci retracement. Here's our 50 to 62% zone. And I'm just going to use, I'll use the 50%. Just say we entered the 50 right here. Okay, our stop loss. Our stop loss has to go above this high right here. And I'm just going to extend this out a little bit so those lines don't get in our way again. And our target is 147. All right, let's get there, close enough. So look at the reward to risk on that. 3.74 to 1. Almost 4 to 1. Okay? And you can see the market moved right down to the equal legs area, that 147. Found a little bit of resist or support, and then continued down. We continued down stronger here. Okay, but this was a case where we had a larger divergence. Now we had an extension here. We had an extension here. Okay, but this could have been a completed pattern and the market looking to turn up. But when we saw the structure of this rally, and actually right here, this is what we call a diagonal. All right, so this was a three-wave cycle, but it ended in a diagonal move. And we'll talk about, we've already covered wedges here, but this is a really good example of, of a wedge, of an ending diagonal. This is a wedge. Okay, and look how it diverged all the way through. Remember, we talked about that, and we'll talk about that a lot. These wedges will diverge all the way through. strong breakout, found support right here near the beginning of the wedge before it pulled back. All right, but we had a nice strong extension move here, and that gave us a really good clue that we were going to continue this to the downside for a second leg of this cycle. Okay, but equal legs target. And we showed that a lot with these patterns earlier. That's the reason that we target these equal legs levels, because it is such a common target for these patterns. Okay, for our ABCs, for our doubles, for our triples. Okay, now remember, we also trade regular patterns. It doesn't necessarily mean there has to be a divergence. A lot of times we use divergence, or the lack of divergence, to stay with the current trend. Right, and so it's in those circumstances as well. If we have a cycle that ends, and you can just look at this cycle right here. Let's say we look at this particular cycle right here. Oops, I apologize. It's the same cycle we looked at. I just blew it up. Let's find something different. I want to use the same thing. Okay, so here we go. We'll just use this cycle here. So now we have a cycle to the downside. Okay, we're not diverging here. We're not seeing any divergence on this low between the most recent swings at this swing. So we're looking at this corrective pullback as corrective of this cycle, and we're looking for it to continue to the downside. Now, I don't know that this really retraced very deep. We'd like to see it retrace to the 50 to 62%. We didn't quite reach that level. All right, so we didn't quite reach that entry level. But right now, I want to focus on these targets. I'm going to focus on the targets. All right, look at where the market went to. Right through equal legs, right into that equal legs 127 zone. That's why we target these areas. So this was a potential setup here. Didn't quite retrace deep enough. All right, but this was our cycle. We didn't have a divergence. We knew we were going to continue with the trend on this pullback. It fell a little short of our entry, but then moved right down to equal legs 127. Let's say you just want to trade extension setups. Just want to trade extension setups. And this is one of our little advanced setups here for divergence because it doesn't qualify. But we do have divergence. Okay, we have price moving lower. We have the MACD cycling higher. What do we see right here? What do we see right here? You got it. An extension setup. To the high, to the low. This is an extension. This leg extended 162%. All right, that's bullish. That's bullish. If we're trading it at this degree, we're going to wait for a pullback, 50 to 62%. So let's go ahead and draw that in. 50 to 62%. Oops. There we go. Here's our retracement. We're going to target equal legs 127. There's equal legs. Hit the target. Now, this threw a little curveball. We extended. All right, so you might look to trade this back to the upside. We got stopped out. It happens. Okay, it's not infallible. Nothing is in the Forex market. All right, but I think we've shown that it works, or it happens so often to give you a really good probability. And actually, I like this. I like showing some of these. You see the patterns that worked, and you see an extension where it came back and would have stopped you out, because that's trading. That's real. That's the real market. Okay, it's going to happen. So accept it, embrace it, and truly understand that. Okay, but let's just look at this pattern here also while we're here. I like to show this because, I mean, when people start to see this, it really amazes them sometimes. All right, but let's look at this. Here's a three-wave cycle right here. Here's our pullback, okay, to that high. And where did the market come to? Where did the market come to right here? Almost right to equal legs. Missed it by maybe a half a pip. Okay, now for our divergent setup, our very objective divergent setup, we're going to use the extensions. All right, the extensions that we talked about earlier are different than projections. And we basically, whereas, just to explain them again, the projections or expansions measure not only this initial leg and project it, they also measure back to the pullback here. Okay, so we would measure this high down to this low, and that projects this out to the equal legs 127. All right, whereas the extensions, when we're trading our basic divergence setup, we use the extensions. So we have price moving higher, MACD swinging lower, we have a qualified move to the downside. Now we're going to use our extensions. Okay, and these are the extensions. You just add them onto your Fibonacci tool, and depending on what program you're using for your charting package, you'd have to do it a little bit differently. You put in a negative number for mine. So if I'm setting mine up here, you can see I have the negative numbers for the extensions here, minus 0.27, minus 0.618. Okay, those are my extensions that you see here. Here's the regular retracements. Okay, the 50, the 62. On the other side of this zero line are the extensions. So they're just measuring this first leg, and extending that out. Okay, so the 127% extension will be the main target that we use for the divergence setup. Okay, our very simple objective divergence setup. We'll use the 162 at times if we're trading or we see something on the higher degree time frame and we're looking for a larger price move anyway. We're trading off of the divergence. We can use that second target. Okay, so here's another divergence on the Euro-Yen 15-minute chart. We have price moving higher. Okay, we have MACD cycling lower. We have a strong decline here traded through the low. And we'll draw our Fibonacci, whoops, wrong tool, sorry about that. We'll draw our Fibonacci retracement extension tool right here. 62% retracement. Initial target here was the 127, and you can see this even continued down to the 162% before finding some support again, and then continuing even deeper down. Okay, but those are the targets. And what this gives you, at least from the 62% to the 127%, normally, depending on the size of the swing, but normally you're getting a 2-to-1 reward to risk ratio. 50% would be a little bit less. Okay, but with your stop above the high, using that 62%, targeting 127, gives you a 2-to-1 reward to risk ratio. So that strategy kind of has everything built into it. Your stop goes above the high, so you're keeping your stop above the pattern, so you're in a good stop loss place. If you're entering at the 62% and targeting the 127, automatically built in 2-to-1 reward to risk ratio, everything you need right there in that one little strategy. Okay, and when you place your trade targets, this is important. Place your targets as limit orders. Okay, place your target. Don't have a target in your mind. Okay, place your targets as limit orders. And don't be afraid to put your target a couple pips above, say, if you're looking at this 127, don't be afraid to put your target a couple pips above it. Okay, because one thing you'll see a lot of times, now this continued and went through, but for some reason you'll see a lot of times price will fall maybe a pip or so above these levels, and you don't want that to happen and it just turn around on you. So, don't be afraid to put it a couple pips above the actual levels. Okay, it's not going to make that big of a difference in the long run. Now, whatever you decide to do, if you decide to put it, say, 2 pips above it or 3 pips above it, do it consistently. Do it consistently and write that down as one of your rules, because what you don't want to do is, it's still going to happen. Trust me. If you put your stop 2 or 3 pips above that level, it's still going to happen. All right, you're still going to the market's going to come a pip or 2 away from it and turn. It's going to happen. Then what are you going to do? You're going to start putting your target 5 pips, 10 pips. Don't do that. Don't do that. Just wherever you want to set it and lock it. Lock it in stone. Put it in your rules and leave it there. Okay, don't mess with that. Okay, but that's how we will place our trade targets most of the time for most of our patterns here. And again, we'll talk more about the very specific simple objective divergence strategy here in a little while in another segment. But you basically have the foundation of it here.